Hello, welcome back. Now, here are the promised few international aspects of German income tax. The first important thing is that persons are treated differently according to the fact if they live in the inland or not. If you live in the German inland, that means if you have your home here, or if you usually stay here in Germany for a long time. So if this is your habitual abode, as it is called, then we tax your income from all over the world. That's the so-called unlimited tax liability. And you must know that unlimited tax liability has nothing to do with the rates or the amount. It just means the tax base is not limited to inland income. It's the income from all over the world. Other countries have similar approaches, and the only thing they do differently is they use different technical terms. But in most cases, nearly 90% of all countries have a kind of taxation of the worldwide income of their residents. So a kind of resident taxation or unlimited tax liability. Those taxpayers who do not live in Germany have to pay taxes to Germany only for all their income from the German inland, as far as the German legislator regards it as adequate to raise a tax claim. In that case, we speak of limited tax liability because in that case, the tax claims are limited to the inland income. As I said, most states have the same basic system. There was once an entry in the English Wikipedia version on, I believe, international taxation, where there could be found a list of over 200 countries, and more than 180 of them had a kind of worldwide income taxation. So this is very, very much a basic aspect of not only the German system, but most income tax systems worldwide. They tax everything you have all over the world. Um, you can probably remember that states can apply their laws under international law in general to people who have a connection to their state or to what people do in their territory. And here you see how fine this principle has been mirrored in the area of taxation. If the person is connected to a state, everything that person does will be taxed worldwide. And if the person has no connection to a state, so that we can only tax what the person does in the inland, then we do so. And most other states follow us in that principle. Now, naturally, there will also be reasons for that. Why do we have an unlimited tax liability? And why do we claim everything which a person has worldwide? Well, if you want to understand why a law has been written the way it has been written, just imagine it were otherwise. So just imagine a state like Germany or France or any other does not raise a tax claim on the worldwide income of one of its inhabitants. Well, then imagine it could be possible that 60% tax rate would be levied in the inland. And now imagine 10 meters beyond the border you only pay 10. Naturally, then all your inhabitants would have a strong motivation to shift all their property and all their economic activity as far as they can to the other country. So if you don't raise a tax claim on the worldwide income of your people, you give them a very strong incentive to profit from lower tax rates abroad. And that might be something which is very, very dangerous to your own economy, because it might happen that only for tax reasons you cause your people to shift their economic activity to countries abroad, and then everybody does no longer want to become active and earn money in the inland. So a state which does not tax the worldwide income of its citizens risks that it ruins its own economy. And that explains, without any ado, that many states, or nearly 90% of all states, do exactly that, because that problem is everywhere. And so, similar problems, similar solutions have to be expected naturally. That's common sense. Now, why do also most states have a limited tax liability? Again, just imagine what could happen if we had no limited tax liability. So if foreigners could earn money in the inland without paying taxes, or without paying at least our taxes. Well, imagine again, you have in the foreign country a tax rate of 0 or of 10%. And here at home you have, let's say, 60% tax rate. Please, at the moment the highest German rate is 45, but I like extreme examples, so we have here 60%, and abroad we have 10 or 0%. Now, imagine somebody living abroad makes an investment here, earns 1 million, and after tax, if that person only pays taxes at home, 10%, after tax that person can have 900,000 and reinvest them. The German competitor doing exactly the same can only have a net income of 400,000 minus 60% taxes and can only reinvest 400,000. You will see that the foreign competitor running a farm or owning a house or anything like that here in the inland can reinvest far higher amounts than the German competitors, the Germans living here. And that would bring a very strange situation in the long run. The foreigners could always have a better net return, so they would do better and they would probably outcompete their German competitors. Naturally, that can't be in the self-interest of a country. If you allow that foreigners can, on your own territory, earn money as competitors and as your own people, and then automatically, due to tax reasons, win competition over them and exclude them from the market in the very long run, that's nothing which any state can allow to happen. So naturally, every state will try to make sure that foreigners at least pay the same taxes as their own citizens in their country, at least in all those inland areas, or in all those inland activities where competition of foreigners is, let's say, to be feared. And so you will have to expect there will be a limited tax liability on the revenue from, or the profit from, firms in the inland, from houses in the inland, and from other investments in the inland where the net income might be reinvested. So if you want to avoid that in the long run, just due to tax reasons, your inland investments are completely taken over by foreigners, you have no other choice. It would even mean, for example, if a source of income is for sale in the inland, then foreigners could bid higher prices, because a source of income is valued according to the discounted present value of all the cash it generates for the investor in the future. And that would be higher for foreigners, so you would even have distortions in the market prices. And so that's something which nobody wants and can allow. So we have then automatically two tax liabilities in most income tax systems, an unlimited one and a limited one. So in every cross-border case, we have a clash of these two principles, because in the country where the investor lives, he, she, or it will be taxed, and where the money was earned, there will be a limited tax liability. So again, a tax. And that again brings an enormous additional problem, namely the problem of double taxation. Imagine, for example, you have an unlimited tax liability in a country where the tax rate is 60% and a limited additional tax liability in the source country where you earned the money, and there the tax rate might be 50%. Then if you want to fulfill your tax burdens, pay 60%, pay 50%, then you have to pay 110%, which is probably impossible if you don't print your money yourself somewhere in your cellar on some hidden printing machines. It's nearly impossible to pay for 100% of the profit. And so that's an additional problem which shows up and will probably be expected everywhere in cross-border contexts. And that is naturally a problem which we have to deal with in the whole second chapter of this lecture series, double taxation treaties and double taxation methods. So keep this in mind. Good. Yeah, the next short information will be on the basics of German corporation tax. And as you know, that's again something for another very short video. Thanks for watching. Till next time.